Your profit and loss is showing a profit, but your bank account tells a different story. Sound familiar? That's because profit and cash flow are not the same thing. And it's critical to understand the difference so that you can make better business decisions. Today, I'm breaking down one of the most misunderstood concepts in business finances, and that's the difference between profit and cash flow, and why it matters more than you might think. Hey everyone, I'm Jamie Trull, CPA, profit strategist, and soon to be published author of my very first book, Hidden Profit. Available for pre-order now. If you're ready to stop leaving money on the table, hit that subscribe button and let's get started. And stick around to the end because I'm going to talk about one of the most common traps that small business owners fall into when it comes to cash flow and a simple shift that can save you from financial stress. So first of all, what is profit? Well, from an accounting perspective, profit is the difference between the money that you bring in and the money that goes out. So first, let's start with what actually is profit. And there are lots of different subcategories of profit: gross profit, operating profit, net income. There's a million different ways to slice it. But at the end of the day, profit itself is really just a formula. It's revenue, i.e. the money you made, minus deductible expenses, which is the money that you spent that you can deduct for taxes, equals profit. And profit is what we pay taxes off of. But just to make things more complicated, profit has a thing that I like to call accounting funny business. And that's what makes it more of a paper calculation than an actual in the bank thing. Now, typically you will see profit and cash flow align a lot of times, but not always. Because cash flow is what's actually happening in your bank account. It's going to track the real money that's moving in and out. And it's going to exclude all of that weird accounting funny business. So you could technically have a profitable month on paper and still not be able to pay your bills. And that's why cash flow and not profit is what actually keeps your business alive. So let's talk about some of those different reasons that your cash flow might not align with your actual profit on paper. Now, the first and probably most common reason is if you are using the accrual basis of accounting. Now, most of the time, this is reserved for larger businesses, but ultimately that just means that you're going to record that income on your profit and loss as income when you earn it, not when you actually receive it. So for instance, if you've earned income and you've invoiced the customer for that income that you've already earned, even if that invoice hasn't actually been paid yet, you can record that as income on your P&L. And similarly, if you've incurred expenses that you haven't paid yet, they're still accounts payable to you, those are included as expenses on your P&L upfront as well, even before you pay them. Now, again, most smaller businesses are cash basis, mostly because it's easier. It's easier to track, and that means that you're recording the income as income when you receive it. You're recording the payments as payments when you actually make them, i.e. when it's leaving your bank account or when you charge your credit card. So that's a really big differential for why cash flow might not equal profit if you are using that accrual basis of accounting. Now, ultimately, that just ends up being a timing difference, right? Because maybe you're recording that income and you're not collecting it until later, but it can create what's called a cash flow crunch. So if that's happening to you and you're profitable on paper, but your accrual basis and you're realizing that you don't have any cash available, you might want to look at how you collect cash. So for instance, can you increase how quickly you collect that cash from customers? Can you even bill up front? In some industries, that's totally acceptable to bill for work before you do it, and maybe even preferred because now you're less likely to be chasing uncollectible accounts. But if you're a cash basis taxpayer, that doesn't mean that you are immune to having these profit versus cash flow differences. So we're going to talk about a few reasons that might still be happening to you. Now, this is super common in inventory businesses. So if you're a business that buys, holds, and sells inventory, then typically that inventory is not going to be recorded as an expense when you pay for it. So the cash is going to go out the door, but you're usually going to actually put that on your balance sheet. And the reason for that is because of, again, accounting funny business. It's one of the accounting rules that you can't record it on the P&L as an expense until it's actually sold, i.e. cost of goods sold. So that allows the revenue that you're making, the money, the income that you're making from the sale to align with when you're recognizing that expense as well. And that's what's called the matching principle in accounting. Don't worry, I'm not going to get too deep into this, but ultimately the goal of the matching principle is for revenue and expenses related to a particular transaction to generally align as far as timing goes. So if you're buying inventory, i.e. the cash is going out the door, but you're holding on to it and not selling it for a while, right? Then you end up in a situation where you haven't gathered the cash, you haven't sold it, so you haven't collected the cash yet related to that inventory, and it's just sitting on your balance sheet. So the money's gone out the door, and you haven't collected, you haven't sold it, so you can't actually expense it. So now your profit, you might be showing that you're profitable because those expenses aren't showing up yet, but you don't have any money in the bank. And this is really common, especially in inventory businesses that are growing a lot, because what you end up seeing is you end up taking the money that you make from your sales and then you're reinvesting them back into more inventory. And therefore you're always in a situation wondering where the cash went. It's why I recommend anybody with an inventory business, make sure to have an inventory budget and make sure you're also routinely paying yourself. It's very easy to plow everything back into buying more inventory. And then it could be, a long time from now before you actually get to see the fruits of that labor. So take a little bit of profit along the way, even if you're trying to grow your business quickly. So inventory is one reason. Another reason your profit might not match your cash flow is if you're making payments on debt. So I'm not talking about credit cards here necessarily. I'm talking more about longer term debt that you have interest payments. Maybe you've got a loan that you took out for your business, right? And you're paying off that loan. Well, that cash payment is actually going to be obviously reducing your cash flow because it's cash going out the door, but it's not going to be reducing your profit in your business. And that's because, kind of like inventory, the debt that you entered into is actually on your balance sheet, this time as a liability. And as you pay that off, that is what is going to reduce that liability. So again, when you took out the debt, you didn't have revenue that you had to pay taxes on for that debt, right? That was a good thing. But similarly now, as you pay off the principal amount, you're not going to have an expense for that debt either. The only expense that shows up on your profit and loss is going to be the expense for interest that you're paying on that debt above and beyond the principal payments. So that's another thing that can cause this mismatch of profit versus cash flow. You might be saying, well, wait a second, my accountant said I'm profitable, but if all that money was going out the door to repay loans, you may not have any cash sitting in your bank account at the end of the day. Now, another reason that you might end up in this boat of your cash flow and your profit being a mismatch is if you are buying assets for your business, larger assets, machinery and equipment, things like that. Those things are going on your balance sheet, right? They're not actually being expensed right away, typically. Now, there are some different tax laws where you might be able to expense them more upfront. But if you're in a situation where you're not doing that, then you are likely going to be what's called capitalizing them on your balance sheet. And what happens then is over time, over the useful life of whatever you bought, the IRS has all kinds of different useful life tables that you can figure out. But let's say it's 5 years, you buy a new big computer setup, and it costs you $8,000. And so you're actually recording that over a 5-year period. So you're taking $8,000 divided by 5. I don't know why I chose one that wasn't an easy thing to do in my head. Okay, I used my trusty calculator. It's $1,600 a year if you're depreciating it, straight line. So that means that you're depreciating, let's say, $1,600 a year. That means that $1,600 a year of that equipment is what's showing up on your P&L as an expense. So instead of the full $8,000 that you paid up front for this, you are instead getting a $1,600 deduction every year for 5 years. So that's another reason why your cash is not necessarily going to match up with what you're seeing on your P&L. So again, you might have guessed that depreciation is another one of those things that I consider to be accounting funny business, and it just makes things much more difficult. But again, the purpose is to match, right? Because you're going to use that asset not just in the first year, they don't really want you, accounting rules don't want you to expense the entire thing. They want you to match it with the time period in which they expect you to use that to generate income. So again, this is trying to match expenses and income, but it's just making things a lot more difficult, especially for smaller business owners. On the plus side, that's why the IRS does have some relief related to things like upfront depreciation that you can take, accelerated depreciation. So if you're somebody who buys a lot of assets, you definitely want to talk to your accountant about that. And another reason that there might be a mismatch between profit and cash flow is if you're taking distributions out of your business. So if you are taking owner draws from your business, that is a balance sheet type of activity. It doesn't show up as an expense on your P&L. So that means that your P&L is going to show as profitable, but you've already taken distributions of that cash out of your business and therefore reduced your cash balance. So all that said, what is the biggest cash flow trap I see? And it's basically assuming that what your profit is spendable cash. And unfortunately, that's just not the case. We don't want to make decisions based on profit alone. It is important, but we also need to be considering cash flow. So how exactly do we make sure that we're maximizing our cash flow? Well, first and foremost, it's about the tools that you are using. So I have a few tools I use in my business to help me with cash flow. Now, I actually don't use a cash flow forecasting tool, mostly because I find them inaccurate and they can be really expensive. Instead, I have my own template that I've put together that I use literally every single week. It is one of the things I do every what I call Money Monday. I update my cash flow spreadsheet and I take a look to make sure I don't have any expected shortfalls coming up in the weeks ahead. So that has been a game changer in my business. It's the best thing that I do every single week for managing my cash flow, and I actually made it available to you as well. So you can go down below and check out my cash flow template or go to jamietrull.com/cashflow and you can grab it for yourself. Now, the other thing that I do to manage my cash flow and use the systems that I have to help me is I use Relay, which is my business banking platform, to be able to separate my money into multiple different buckets for different purposes. So if you follow this channel, I talk a lot about profit planning. You can actually see a little bit more about profit planning and how I use Relay for my profit planning in this video. However, I have to say it has been a massive game changer for me. I'm ultimately able to separate my money into buckets for things like taxes and paying myself and reinvesting back into my business, even having some fun, and also for making an impact and doing things to help causes that you care about. So you can do all of that with your profit, and it really helps to manage it in that way. And I love Relay because it basically allows me to use the envelope form of budgeting for my business so that I don't accidentally steal from one thing to be able to pay for another. So if you want to check out more about Relay and also earn a $50 cash bonus once you fund your new account, go to jamietrull.com/relay to find out more and sign up. Now, if you want to go deeper into understanding this accounting funny business or just understanding cash flow versus profit in a way that absolutely makes sense for a small business like you, I would love if you would pre-order my new book, Hidden Profit, that is coming out in October of 2025. I've worked so hard on this book to come up with strategies to help you find profit that is already sitting within your business and to improve on things like cash flow and how you use your money to create the life that you want. So please go to jamietrull.com/hidden profit and place your pre-order. It also means the absolute world to a debut author to have your support in the pre-order process. And I have some extra bonuses for you too. So we're offering over $300 worth of bonuses just for pre-ordering the book right now. So make sure you go ahead and do that. Please literally go there right now. Press this button on the screen, go pre-order Hidden Profit and claim your bonuses. I'll see you guys next time. Thanks so much.